Hello, everyone. This topic is on long-term sources of financing, where we would be talking about the debt financing. First, let's look at what is debt financing. In debt financing, the borrower receives money in exchange for a promise to repay it at some future time. Which means that the first thing is what is let's look at a debt. A debt is an obligation to repay, and the borrower is, sorry for that, the borrower is known as the debtor, and the lender is also known as the creditor. The amount of money which is borrowed in a debt is also known as the principal, and this amount is repaid at some point in time in future. Uh, but the lender, who is the creditor, also expects that along with the principal amount, which is to be repaid at the end of some period, he receives some kind of compensation for lending his money, which is also known as the return that the lender expects. And that brings us to the meaning of interest. So the lender receives interest in return for lending funds. Now let's move on to an important kind of debt, which is also known as bonds, which is essentially issued by a corporation. A firm may borrow money by issuing bonds. Um, what are the certain important features of bond? A bond is a long-term contract under which a borrower agrees to make payment of both interest and principal on specified dates to the holder of the bond. Also, you should know at this point that the specified dates are mentioned in the agreement, bond agreement. Let me give you an example at this point. For example, on January 1, 2012, Tasty Food Products Company borrowed, say, $50 million by issuing 50 million bonds. Now, Tasty Food Products Company will therefore receive the $50 million, and in exchange, it promises to make interest payment to the lender of the money, who is also known as the bond holder. And this interest payment may be made annually, which is every year. And the issuer, that is the firm, also makes the promise to repay the principal amount, that is $50 million, on a specified maturity date. So, therefore, a firm promises or a corporation promises to repay both the principal amount of the bond as well as the interest, makes promises to make interest payments to the bondholder. Then the bondholder is also maybe known as an investor. Another important thing to note here at this point is that for a corporation which has issued a bond, the bonds are sorry, the bonds are recorded in the liability side of the balance sheet. And another important thing to note here is that the bondholder, who is an investor, they are not considered as the owners of the company. So a bond pays interest on specified dates. Here you need to know is that these interest payments are also known as coupon payment. What is a coupon payment? A coupon is a fixed amount of interest which is paid on bonds each year. The amount of the principal amount of a bond is repaid on maturity date, and a bond also carries an indenture agreement. That brings us to what is an indenture agreement. An indenture agreement is a legal agreement between the corporation which issues the bonds and the bondholders, and it carries a certain information some rights and duties of the borrower is mentioned in the indenture agreement. So as you can see here, an indenture agreement specifies the rights and duties of the borrower. Further, there may be some additional information like the description of the bond, which may include what is the amounts in which the bond payments will be made, whether the denomination, whether it will be in hundreds or 500s, etc. And it will also describe how much will be the interest payments and what will be the dates on which these interest amount will be paid. That is called the description of the bond. Um, an indenture agreement will also specify the remedies available to the borrower in case the remedies available to yes to the borrower, to the lender, that is the creditor, in case the borrower fails to pay. Um, uh, the indenture agreement will also specify the duty of the borrower, which is to keep the bondholder informed about the financial conditions of the borrower, which is the corporation. In addition to this, an indenture agreement may also specify some other terms and conditions, which means sometimes what happens is that the lender, that is the bondholder, imposes some restrictions on the corporation which is issuing the bond, which are called restrictive covenants. And an example of which would be maybe that the bondholder or the lender may put a restriction on payment of dividend by the corporation to its shareholders, which means that until the time until the period of the bond, the corporation cannot pay any dividend to its shareholders from its profits. And this happens in cases where maybe the financial condition of the borrower is not very stable, and therefore the lender wants to protect themselves from any kind of risk of non-payment. So in case there is any such restriction which the bondholder has imposed upon the issuer of the bond, then that will be mentioned in the indenture agreement as well. Now let's take a look at some of the basic features and provisions of a bond issue. And let's begin with value of the bond. So every bond will have a par value, which is also known as the face value. And this value is a value which is stated at the time of when the bond is issued, and this value may also be sometimes called as a nominal value. For example, we generally assume that a par value of 1000 or although any multiple of 1000, for example 5000, can be used. The par value generally represents the amount of money that the corporation borrows and promises to repay on the maturity date. So that is the par value. You can say that the par value is the principal amount of the debt. So that is referred to as the par value or the face value of the bond. Now let's come to the next feature, which is the interest, which is also known as the coupon rate. For example, say Tasty Food Products Company bonds require the company to pay a fixed number of dollars of interest each year, which may be say $100 interest each year. Now, if the par value of the bond is if the par value of the bond is say $1,000 and the interest is 10%, then the dollar amount of the interest would be $100, which is 10% of $1,000, or you can say 1000 into 0.10. That is how the interest will be calculated. The next is the maturity period. Bonds generally have a specified maturity period on which the par value of the bond has to be repaid. For example, again, Tasty Food Products Company bonds, which were, say, for example, issued on January 1, 2012, will mature on January 1, 2027. So that is will be the 2027 will be known as the maturity period. Will be known as the maturity period. Therefore, the maturity period is 15 years. Now let's move on to the next feature, which is security. This refers to the fact that a bond may either be secured or it may be an unsecured bond. Um, so that is, in some cases, the bonds are secured by any specific property, which is called a collateral. If the conditions of which means under which if the conditions of the loan are not satisfied, say for example, if one of the conditions of a bond agreement, which is repayment, which is payment of interest to the bondholder, say for example that condition has not been fulfilled by the company, then in that the bondholder will be able to recover the amount of the principal amount or the interest amount from the sale of the collateral, which is kept as a security by the issuer or the corporation against the issue of the bond. So again, to make it clearer for you, a security is some kind of a collateral against which the bond is secured, and if the bondholder wishes, then he can recover the amount of his principal amount of the bond or the interest amount from the sale of that collateral or the sale of that property which belongs to the corporation. So if there is any such security kept by the corporation, then that will be mentioned. Seniority is not very important. And then we come to convertibility. This conversion feature of a bond gives the investor the right to exchange the bond for some other security of the issuer, which means that if the bond, a bond may have a condition in the agreement that in case the bondholder wishes, he can convert his bond into a common stock or a common share at a predetermined rate of exchange. That is, the rate at which it is exchanged is mentioned, and that is called as the convertibility feature of a bond. Now let's take a look at the type of bonds. Basically, there are two types of bonds. One is called as the first one is the government bond, which are also known as treasury bonds. Particularly when the bonds are issued by the US government, it is known as treasury bonds, and it is issued by the federal government, which is also known as the central government of a country. It is reasonable to assume that the federal government will always make the promised payments, which means that it's very rare that the government will default on the payment of either the interest or the principal amount or the face value of the debt. And because of this, the treasury bonds or the government bonds are said to have no default risk at all. That means there is very little risk of non-payment on such bonds. So no default risk is one feature of the government bond. Then we come to the corporate bonds. Corporate bonds are the bonds which are issued by corporations, and there is a default risk on corporate bonds, which are also known as a credit risk. Default risk, so default risk is also referred to as the